Hey guys, there's been some big changes recently in regards to first home buyers in Australia. So I thought I'd do this updated video to show you all the offers that are out there for first home buyers and go through exactly what your options are. So this first video will be on Queensland. So if you're a first home buyer looking to buy in Queensland, this should give you all the options that you have available to you. Before we get started, my name is Nicholas Allen. I'm a mortgage broker with Kingfisher Finance Group. So if you're thinking about getting your first home or even your first investment property, feel free to reach out and book a chat with us, and we can help guide you through the whole process. So this video is going to go through what government help is available to people in Queensland. We're going to look at a few different scenarios, how we can use this government help to first buy an established home that we're going to live in. Second will be building a home to live in. And third will be buying an investment property. At the end, we'll go through some special lender policies that you might not be aware of, but could actually help you in your situation. So the first of the government help is the first homeowner grant. Now, this has been around for a while, and it's recently been extended until June 30, 2026. So this is available for eligible first home buyers that are buying or building a new home as a $30,000 grant. And as you can see, it's for contracts that signed between the 20th of November 2023 and the 30th of June 2026. So the eligibility criteria for this is that the value of your home must be less than 750,000, which includes any land or contract variations in your build. And the grant is only available for new homes. So if you're buying a home, it has to be a home that's not previously been occupied or sold as a place of residence, or it has to be a substantially renovated home. You also have to be 18 years or older, and you must be an Australian citizen or permanent resident, or if you're not, you have to be applying with someone that is. You and your spouse must have not previously received this either in this state or any other state. So to continue on the eligibility criteria, you and your spouse must not have owned residential property in Australia on or after 1st of July 2000 that you lived in, or anything that's before 1st of July 2000, whether you lived in it or not. So you could have owned property after the 1st of July 2000 if it's only been an investment property and you've never lived in it, but anything before that date, it doesn't matter, you're not eligible. The grant is also not available for those that are purchasing investment properties. It must be an owner-occupied property that you're going to live in. There's no income bearing on the eligibility for this grant, and you also cannot purchase it within a company or trust, so it has to be within your personal name. Now, there's a few special conditions for this grant. So the first is that you must move into your brand new home as your principal place of residence within 1 year of the transaction. So if that's building, it's within 1 year of that final build date when it gets signed off. If it's just a house that you're buying, it's just within 1 year from that settlement date. And you also must live there continuously for 6 months. Now you can rent out the home before moving in and keep the grant, but you still have to be moving in within that first year. You can also rent out one or more rooms in the home during your 6-month residency period, as long as it doesn't affect your use of the house. So if it's just renting out 1 or 2 rooms and you still use the house as normal, it's fine. But if you're renting out the entire house where you don't actually really have access to it, then you might not be eligible. And after you've lived there continuously for 6 months, you're able to then rent out the entire property and still keep the grant. Now, disqualifying conditions. You may have to repay the grant first if you don't move in within a year of buying it. And second is if you don't live in it for 6 months continuously as your principal place of residence. So you might have got paid this grant to buy or build this home, but if you don't follow the criteria, you might have to pay that $30,000 back. So how do you apply for this? So there's 2 ways you can submit an application. First is through an approved agent, such as a bank or lender, which is the quickest option. Or second, you can apply directly through Queensland Revenue Office. And now when do you apply? So if you're buying your home, you must apply within 1 year of taking possession. If you're building the home, you must apply within 1 year of the new home being completed. And if you're an owner builder, you must apply within 1 year of the new home being completed as well. So the next initiative from the Queensland government is the first home concession. Now there's actually 2 that are combined into one here. So there's the first home concession and the first new home concession. You can claim a first home concession for the stamp duty, or transfer duty as it might get called, when you're buying your first home. So eligibility criteria for this is when you're buying established property, the value of the home must be less than 700,000 to get a full concession, and between 700,000 and 800,000 you'll get a partial concession. And this concession is largest when it's at 700,000, and as you get to 800,000 there's eventually no concession. So it gets smaller and smaller as the price goes up. But if you're buying or building a new home, you'll get a full concession that reduces the stamp duty to nothing no matter what the price is. So for this, your contract or arrangement must be dated the 1st of May 2025 or later. There's no value cap for the price of the house. So if you are building, this is known as like the vacant land concession. But if you're buying an established home, it's a new home concession. To be eligible, you have to be 18 years or older. You do not have to be an Australian citizen or permanent resident to actually claim this. You also must have never held interest in another residence anywhere in Australia or overseas. So if you've owned residential property in Australia or elsewhere in the world, you won't be eligible for this. And you must move into your brand new home as your principal place of residence within 1 year of the completed transaction. So again, if you're buying a new home that's already built, it's 1 year from the settlement date. And if you're building a new home, it's 1 year from the construction completion. A couple more on the eligibility. You must have never claimed the first home vacant land concession, and you also must be paying market value for the property. So the special conditions, these can be very similar to the ones we just went through with the first homeowner grant. So you must move into your brand new home as your principal place of residence within 1 year of the complete transaction, and you have to live there continuously for 12 months. You cannot rent out the house before you move in, but you can rent out one or more rooms in the home during your 12 months residency period, again, as long as it doesn't affect your use of the home. You can rent out the entire property after living there continuously for 12 months, and you're not able to sell or transfer all or part of the property before you move in. Otherwise, you don't get the concession. A partial concession may apply if you sell or transfer the property within this 1 year period. So the thing to note is, even though the first homeowner grant, you may only have to live there for 6 months, or you can rent it out before you move in, the criteria for this is slightly different. So if you're trying to take both, you have to make sure you're still satisfying both of their needs. While renting out before you move in is a possibility for the first homeowner grant, you'll lose eligibility for this concession. So you have to make sure you're satisfying both of their criteria. So how do you apply? So there's two ways you can apply for this. You can lodge your documents with a self-assessor. So this is with a solicitor or conveyancer. This is the most common. They'll help you go through that process when you're going through the settlement of either purchasing a property or the construction. Or you can self-lodge with the Queensland Revenue Office. So when do you apply for this? So you want to apply for this once you've entered into a contract. If you're unsure that you meet the concession requirements, you can pay the full rate of duty when the documents are assessed, and you can claim the concession later if you have met or will meet the requirements. So in this scenario, you might pay the money up front, but then get it reimbursed once you've submitted the application. You can also do this if you didn't claim a concession when you acquired the home because you weren't going to occupy it. So say you bought it as an investment property, but then you decided to move in, you had a change of plans prior to actually renting that out, you might be able to go back and apply for a concession. The next scheme is the First Home Guarantee Scheme. So this one has had some big changes that are coming 1st of October, which we'll be going through. So all the information here and criteria will be based off 1st of October 2025 with the updated information. So this scheme allows first home buyers to buy or build a home with a minimum 5% deposit, with Housing Australia providing a guarantee of up to 15% of the property value. And this just allows people, again, to buy with a 5% deposit and not have to pay any mortgage insurance, and they're going to get the more favourable rates as if they were using a 20% deposit. So the eligibility criteria from this, again, from 1st of October 2025, is there's going to be no placement limits. So any first home buyers eligible will be able to use this scheme, and there's not going to be a limit of how many people can use it. There's no longer going to be any income caps. Even if you're a high income earner earning $200,000-300,000 a year, you're going to be able to use this scheme. Previously, the caps were 125 for single applicants and 200 for joint applicants. So you must be an Australian citizen or permanent resident to be able to use the scheme. And both of you, if you're a joint applicant, both of you have to be a citizen or a resident. You have to be aged 18 years or older, and you must buy or build a home to live in. So investment properties are not eligible in the scheme. So you must be a first home buyer, or you must not have owned property in Australia in the last 10 years. So if you used to own property and you sold it and now you've been renting for the past 10 years, you might be eligible to use the scheme as a first home buyer, essentially. You must have a minimum deposit savings of at least 15% of the property value, plus be able to cover any other costs such as stamp duty, etc. And the last thing is that property value must be below the price cap for the location that you're buying in. And these price caps have also been updated to reflect the growth in the market recently. So what type of home can you buy? So you can buy an existing house, a townhouse, an apartment. You can buy a house and land package. You can buy vacant land as long as you've got a separate contract to build a home. And you can buy an off-the-plan apartment or a townhouse. What type of home loan do you need to use a scheme? So it has to be an owner-occupied home loan. Again, can't be an investment property. You have to be using principal and interest payments most of the time, with limited exceptions for an interest-only loan. And it usually will have a term up to 30 years. And you might have an extra 2 to 3 years for that construction period if you're building a home. And how do we apply for this? So when you're wanting to apply, your lender or broker will submit an application to Housing Australia as part of the pre-approval process. You'll just have to sign 1 or 2 documents in this process. So these are the updated price caps as of the 1st of October 2025. So for Queensland, if you're in a capital city or regional centre, the price cap will be $1 million. And for the rest of Queensland, it's going to be $700,000. And the rest of the states will be listed here, but I'm not going to go through them all. Now here's another scheme which is very underused in my opinion, and that's a first home super saver scheme. So this allows you to make personal voluntary contributions into your super fund to help you save for your first home. So you can contribute up to $15,000 per financial year with a maximum of $50,000 across all the years. And the reason for doing this is it means you'll only pay 15% tax on these savings rather than your standard rate. So rather than getting paid, losing a bit of tax, and then putting that after-tax money into your savings, which might be at 30% or more, depending on your tax bracket, you put this money into your super at only a 15% tax rate that you can access later as savings. And this can save you thousands of dollars when it comes to actually using that as your home deposit. So the eligibility criteria for this: you don't have to be an Australian citizen or resident for tax purposes to use this scheme, and you must genuinely intend to occupy the property after purchase and do so for at least 6 of the first 12 months when it's practical to occupy. So this is again very similar to the first homeowner grant, where you have to live in it for 6 months in the first 12, whereas the first homeowner grant is you have to move in within the first 12 and live in it for 6 months again. So slightly different. You don't want to get them confused and lose eligibility from one because of when you moved into it and how long you lived in there for. You must be 18 years of older to use the funds, but you can start making these contributions before the age of 18. So if you start working at 16 or 17, you start making these contributions. And when you go on to buy a house, maybe at 18 or older, that's when you can pull those funds out that you started putting in earlier. So you must be a first home buyer, having never owned property in Australia, and your name must also be on the title of the property you intend to buy. So pretty straightforward. So how do we apply for this? So once you've made the contributions, so the first step is you want to request a determination. Second step is you request a release of your funds. The third step would be signing the contract, and the fourth step would actually be receiving the amount. So you must request your determination before any ownership of property transfers to you. So like you want to be doing this before you go under contract on anything, because once you settle, if you haven't requested that determination, you will no longer be eligible to withdraw those funds that you put into your super. And it does take between 15 to 20 business days for these funds to be released. So if you're needing it for a deposit, again, you want to be proactive, have a decent settlement period on there, and put in your application sooner. That way you've got the funds ready to settle on the property when you need it. Now, how do you make these contributions? So you can contact your employer to start making salary sacrifice contributions to your super, or you can just manually make voluntary contributions to your super. Any of your super guarantee contributions made by your employer are not eligible for the scheme, so it's only those extra ones you do on top that you can actually withdraw later. So this scheme, the Booster Buy scheme, hasn't been fully rolled out yet, but it's teased to be coming later in 2025. So I thought I'd go over it and give you some of the basic details that are currently available. So what this is, the Booster Buy will offer an equity contribution of up to 30% for new homes and 25% for an existing home, meaning you'll be able to purchase a home with less of a deposit and a slightly smaller mortgage because the government will be taking an equity stake in the property essentially. So first home buyers will need a minimum 2% deposit for the purchase price of the property, and the property can be valued up to $1 million. There will be income caps for this. It's currently set at 150 for single and 225 for joint applications. And the full other eligibility requirements for the scheme will be released once it's actually open for applications. There's no more information that's been released yet. Very similar to this is the Help to Buy scheme, which is the federal scheme, and this again is an equity share program, and this is limited to 40,000 Australian households to purchase a new or existing home, again with a contribution from the Australian government. So this means eligible Australians can purchase a home again with a smaller deposit and mortgage. So for this you have to be an Australian citizen, 18 or over, 2% deposit again. There'll be property price caps depending on the state and region, and there'll be slightly smaller income caps for this one. It's going to be 100,000 for single, 160 for joint. You also must be unable to purchase the home without the assistance of the Help to Buy program, meaning if you can afford to buy a $600,000 home, you can't try to use a scheme to buy it and have to have a less mortgage by only paying for say $450,000. You also must be using the purchased home as a principal place of residence, so again, no investment properties, and you're currently not owning any other property in Australia. So it's not limited to first home buyers, but just to people that don't currently own any property. And you also must be paying all property purchase fees and taxes, such as stamp duty and that. And these are the proposed price caps for the scheme in the different states. So again, Queensland, 1 million for the capital city and regional, and then 700,000 for the rest. So the way both of these equity share schemes are going to work, in case you're unaware, is up to a certain price point. If you can only afford, say, a $500,000 property on your own, having this equity share means the government's going to go in, whether it's 25, 30, 40%, and boost the amount that you can actually buy. So maybe you could only buy 5 or 600,000 before. Now with the government helping you, you're going to be able to buy 7 or 800,000, but you're just going to be owning your portion of it. So maybe you buy for 800,000, but you own 600,000 of the property, and then the government owns the 200,000. And the way this is going to typically work is if the property goes up in value by 20%, that value increase is shared. So the government's portion is going to go up 20% and so is yours. So now we're going to go over a few of the scenarios. So the first scenario is if we just buy an established home to live in. So this is a home that doesn't qualify as a new home. It's been lived in before. So we're not going to get some of those, like the first homeowner grant, but we're going to still get some of the other concessions. So we've got 5 different price points listed here from $600,000 to $1 million. I just show you the differences of what we're going to have to pay in terms of stamp duty, government fees, what a 5% deposit looks like, and any other costs. So you'll see here 600,000 and 700,000. You're going to be qualifying to get that full stamp duty concession. So your main upfront cost here is going to be a 5% deposit. So 30,000 if it's a $600,000 property and 35,000 for a $700,000 property. Now you're going to have a couple thousand in there for government fees and a couple thousand for like your conveyancing, building and pest, stuff like that. So this total deposit required is the savings that you would need to cover that deposit and any upfront costs. And then this is the total loan that you'd have to service. So again, $600,000 property, about $35,000 deposit, $570,000 loan. And you see very similar for 700. And you see when you get to 800, you're no longer getting that stamp duty concession. So you're having to pay an extra $22,000 on top. So you've got your 5% deposit, got about $25,000 here, plus 2.5. So you've got nearly 68,000 you're now needing to save with a $760,000 loan. And you can see it's the same case again for the 900,000 and the 1 million. So while again with a $1 million property, yes, you only need 50,000 if you're using the 5% deposit scheme, then you need another 37 to 38,000 in all the other costs. So really you're needing close to $90,000 to be able to get in with a 5% deposit scheme. So it's not quite as simple as just a 5% deposit. You still have to cover all of these other costs on top, plus be able to service a $950,000 loan. But you can see down the bottom here, I've listed what schemes you're eligible for in each one. So the first homeowner grant, not eligible for any of them because it's not a new home or you're not building a home. Stamp duty concession, you get a full concession up to 700,000. If it's between 700 and 800,000, you're going to get a partial concession. But once you hit 800,000 and up, there's no stamp duty concession unless you're building a brand new home or buying a brand new home. And the 5% deposit scheme, as long as you meet your eligibility criteria, you're able to use it for all these price points. But again, 1 million and up, you're not going to be able to. Or if you're in regional Queensland, you're only going to be able to go up to 700,000. And these price points are going to look a bit different, either paying mortgage insurance or having a bigger deposit. So this next scenario we're going to be looking at is if you're building or buying a brand new home that you're going to live in. So we're using the same price points here, just to compare the differences. And the real benefit we're going to get here is being able to use that first homeowner grant and also that stamp duty concession. So if we look at 600,000, we're paying no stamp duty. You're paying a few thousand government fees. You've got 5% deposit. Then you got your other costs. Because we're able to use that first homeowner grant, we're actually going to get a $30,000 grant, meaning all we're paying up front really is $5,000. Now, you do need to be careful with this because depending on the scenario, you might not be getting that first homeowner grant up front. So you might not be able to rely on that as a deposit, but in some scenarios you will be able to get in with a smaller amount. But worst case, you might have to save that extra, but then you're going to get it straight back at some point. And again, this is going to leave you with a loan 570,000 like before. 700,000 also get no stamp duty. Again, very similar, and we're also going to be getting that $30,000 first homeowner grant. I have made a typo down here. This stamp duty concession is supposed to be yes for everything, but you'll see the first homeowner grant stops once you get to 800,000. That's because the property threshold is 750. So once you go over 750, you're no longer getting that 30,000. So for $800,000 property, you're going to be paying 45,000. Again, it's going to be cheaper than if we go back than here because you're not paying that 22,000 up front for stamp duty. So instead of nearly 68,000, you're doing 45,000. And you can see the numbers for each of the 900 and the million. Again, you pretty much are only saving the 5% deposit plus the few thousand on top rather than having to pay 20 to 30,000 as well for stamp duty. So hopefully this gives you a decent idea of what's actually required to be saved if you are going to be using these schemes and what sort of property you're going to be able to afford with your size of deposit. But again, it also depends completely on how much you can actually afford to borrow. So that's where you need to speak to a broker, understand your borrowing capacity. If you know you can borrow up to $800,000, then you know what you sort of need to be saving towards. But there's no point saving towards this if you can only borrow 570,000 because you don't need this much. So again, speak to a broker early. A lot of clients that I deal with, I'll speak to them 6 to 12 months before they're looking at buying. They're only just starting their saving, but they need to know what they're saving towards. They don't know what they're going to be able to afford. So again, they get that bit of information early. They put a plan in place. They know exactly how much they need to save, how big of a loan they're going to have, what sort of property price they're looking at, and they can spend the next 6 to 12 months working towards that. And when they're ready, they'll come back to me and we'll go through the process. All right, last scenario we're going to look at is buying an investment property. So you'll notice all these first homeowner schemes don't have any incentives for buying an investment property. So a lot of first home buyers actually do buy an investment property for the first property. I was one of them. And a lot of people, they choose to rent invest. So this may cost a bit more upfront because you're not going to get any of those concessions. You're going to be paying the full stamp duty. You're not going to be able to get that 5% deposit scheme. And you're not going to be able to get the first home and a grant or anything like that. So you're paying everything full price. But there's many reasons people do buy an investment property as their first property rather than buying a property to live in. And whether that's you're not ready to settle down in one location, and if you're potentially working like a FIFO job, you're moving around a lot, then there's no point to buy a house to live in. Then it might be more advantageous buying an investment property. Or potentially you live in an expensive area such as Brisbane or Sydney or something, as you're paying $1 million, $2 million for a decent house. And if your borrowing capacity is, even if you've got a decent borrowing capacity to buy something for 800,000, maybe it's not something you want to live in. So instead you spend that money elsewhere on an investment property where it doesn't have to be somewhere you want to live. It might be in another state, but wherever it makes sense financially from an investment standpoint, might be a suburb that's growing really well. You want to put your money to work in an investment property somewhere like that, then sometimes it's worth forfeiting those benefits you might get to be a first homeowner, pay a little bit extra up front, but you get an investment property in a great location where you're going to make more money anyway. So that's where I see it's advantageous to be buying an investment property instead of waiting in the hopes of being able to use that first home incentive, which may only save you 20 or 30,000. But if you're waiting 2 to 3 years to be able to use that, the market's going to be moving a lot more than that anyway. So you've really got to weigh up your options. So with this, you'll see we use a 12% deposit on this. And the reason we're using a 12% deposit is we want to keep the LVR, so the loan to value ratio, we want to keep that at 90% or better when we're including the LMI in there. The reason for that is you're going to get slightly better rates. Some lenders don't want to go past 90% LVR, and those that do go past it charge a much higher LMI premium. So if you do that 12% deposit, when we include that LMI cost, which is often around that 2%, it's then going to go up to a 90% LVR. So again, we go through the cost, 20,000 stamp duty, 12% deposit, 72, roughly 11,000 for LMI, a few thousand for other costs. You're looking at about 97,000 with a $540,000 loan. So upfront costs, again, much higher for an investment property because we're not getting all those incentives. So I'll let you pause the screen. You can look through all the numbers here. But you can see, like, again, for $1 million, if we compared to the last slide, 56,000 compared to 165,000 to get into $1 million property when you're building to live in compared to buying an investment property. But again, if you've got those savings there, sometimes it's worth paying a bit extra to get an investment property rather than sitting there on the sidelines just waiting. So now we're going to jump into what other options you might have. So one is actually using a guarantor. So if you're not someone that's eligible for a lot of the first home buyer schemes, or maybe you want to buy an investment property, stuff like this is when using a guarantor is super helpful. Even if maybe you just don't have the savings yet, but you've got the income to service the loan, again, guarantor can be a great option. So What is a guarantor? A guarantor, often a parent or close relative, uses equity in their own property as additional security for your loan. So instead of you needing a full deposit, paying lender's mortgage insurance, um, the lender takes security over a portion of the guarantor's property to cover the shortfall. So essentially what this means is when a bank gives you a loan, they want you to have 20% of the meat in the property. So whether as a 20% deposit or like with the 5% deposit scheme, you have 5% and the government looks after the extra 15 to get to that 20%. Or otherwise, you have a smaller deposit, you pay mortgage insurance. What a guarantor allows you to do is if the guarantor has enough equity in their property, the bank can take security in part of their property to make up that 20% buffer in a way. So for $1 million property, you're needing $200,000 to make the bank happy, has a 20% deposit. You might not have that money, but a parent or close relative might have that as equity in their property. So the bank's just going to take $200,000 security in that property. You're still going to be the borrower. The guarantor doesn't make any repayments or anything unless you default. And the guarantor's liability is usually only what they've secured. So if that's $200,000 or $100,000, that's their liability. It's not going to be the entire property. It's just that portion that they've given security on. And once your property has enough equity, so usually around that 20% plus mark, the guarantor can be released from a loan. So this can either be done by paying down your loan till you get that 20% of equity, or the property increasing in value enough where you again get that 20% equity. So sometimes you can be paying almost nothing off the loan, but if you've got a good growth market and the property grows in value enough, say from like 1 million to 1.2 million or something like that, you might then have enough equity to remove that guarantor and just have all the security on that property. So how can a guarantor help you? So it avoids or reduces the need for a deposit, with several lenders allowing you to loan up to 105 to 107% of the purchase cost, meaning you can buy a property and cover the stamp duty all with the loan and put $0 down. So what this might look like is buying a property for 500,000 and getting a loan for 525,000 or something like that, which covers the purchase of the property plus $25,000 of upfront costs such as stamp duty and stuff like that. As mentioned, this avoids lender's mortgage insurance, which can save you tens of thousands of dollars. You get access to better interest rates. So instead of being in a 90% LVR territory, it's going to be treated like it's an 80% LVR, like you've got a large deposit, which means it's less risky for the banks and you're going to get slightly more favorable rates. You also have more flexibility in terms of when you compare it to the government schemes, because a lot of the times you can use a guarantor to buy an investment property, or it can be a property you live in, and you can sort of change your purpose without penalty of having to pay something back. And there's limited eligibility criteria if you compare it to the government schemes, so it doesn't depend on like your income or property prices. The only income that matters is how much income you have to be able to service the loan, but there's no caps or anything like that. You don't have to be a first home buyer, and yeah, you just have to be able to service the loan and have enough equity in the guarantor's property, and they obviously have to agree to be guarantor. Doesn't have to be a first home either. And even if you own property, you can quite often, there's some lenders which will allow you to buy a second property by using a guarantor. So again, lots of options out there, and it gives you a lot of opportunity, especially if you don't have that deposit saved yet, but you don't want to be sitting waiting for 2 to 3 years to save that money while the market's going up in price. Right, next one, LMI waivers. So an LMI waiver, essentially pretty self-explanatory. It means you don't have to pay LMI, lender's mortgage insurance, even if you have a deposit that's less than 20%. So again, typically if you don't have that 20% deposit and you don't have a guarantor or the government schemes, you're gonna have to pay mortgage insurance to get the loan because it's more risky for the bank. But some banks are offering waivers if you can fit the eligibility criteria. And this is often for owner-occupied properties, but some lenders do allow this for investment properties. It's usually for LVRs up to 90%. So if you've got a 10% deposit, you might be able to get in without having to pay mortgage insurance. But sometimes, depending on the bank, you might even be able to go up to 95% LVR, meaning you only need a 5% deposit and you still don't have to pay mortgage insurance. So who's eligible for this? Usually medical professionals such as doctors, dentists, specialists, vets, pharmacists, multiple options like that. Allied health professionals, legal professionals, so if you're solicitors, barristers, judges, accountants or finance professionals, stuff like that. Engineers, IT professionals, certain government professionals, and then education, essential workers, frontline workers. There's a fair variety of professions that are eligible. The only thing is you're going to need to show proof of that you're registered in whatever field that you're in. But if you do fall into one of these careers and you'd like to see what is available to you, and if you qualify for these LMI waivers, feel free to reach out and we can see what's available to you. All right, next one is HECS/help debt. How does this affect your borrowing capacity? So in the past, it's been treated differently to how it does now, and that's because they've changed the regulations on how it is to be treated compared to other debts, which means some lenders are tweaking their policies to make it more favorable for those that do have help or HECS debt. So lenders don't usually focus on the balance, but they focus on the repayment amounts, which obviously grow with income. So whether you've got maybe a $50,000 loan or an $80,000 loan doesn't typically change the amount of money you can borrow, but what does affect your serviceability is obviously how much you're paying per year, and obviously that grows with income. So the more you're earning, the more HECS you're paying, which means the more it impacts you. As I mentioned, APRA has changed its regulations, which means the serviceability assessments that include HECS and help can be changed by the lenders and treated differently to other debts, which some lenders have already taken up. So some of the special policies, we've got Commonwealth Bank, which did this earlier this year. And if you can repay your help debt within 12 months based on the standard, based on your payment profile, CBA excludes it entirely from serviceability, so it's not included at all. It's treated like that debt doesn't exist. If you're repaying it within 1 to 5 years, they do include the repayment, but they reduce your serviceability buffer to 1% instead of the usual 3%. So what this means is when you're looking to get a loan with the bank, they're looking at if you can service that, but they also put a 3% interest rate buffer on that debt. So if you're looking at a 6% interest rate, they're going to see, can you afford it at a 9% interest rate? So they're stress testing what debt you can afford to take on. But with this policy, they're only using a 1% buffer instead of the usual 3%, meaning you're going to have a lot more borrowing capacity because they're not stress testing it as much. So this might be, like with this policy, it might be anywhere from 10,000 in your HECS up to 50,000 or more, depending on how much you're paying per year and what your income is. You might be paying off a pretty significant debt within 5 years, which means you might be eligible for this special policy. The next bank with some special policy is NAB. And again, they did this earlier this year, and they'll exclude any help or HECS debt with a value of 20,000 or less. So if your HECS debt is 20,000 or less, it's completely ignored, like it doesn't exist. So pretty simple, that one. And then the latest bank to put in some policy is ANZ, which will be coming out on the 15th of September this year. And that will just exclude your HECS or help debt from your debt to income ratio calculations. So usually when you go on to get a loan, they'll have a debt to income ratio, and that's your total amount of debt compared to your total amount of income. And essentially this is just getting left out from that ratio, which will improve your serviceability to some extent, depending on what your current debt level looks like and what you're trying to do. So I don't think it's going to be as impactful as Commonwealth Bank's and NAB's policy, but it's a step in the right direction, at least from ANZ. So that wraps up everything we're going to go through on this video. So hopefully it gives you a good idea of what's available to you in terms of government schemes and other little policies out there that you might be able to take advantage of as a first home buyer. Quick shout out on our website, we've got some great free calculators, from a loan calculator where you can calculate like extra repayments and offset accounts, how it's going to adjust your loan. We've got a purchasing power, a refinance calculator, and a stamp duty calculator. So it gives you a good overview of what you might be looking at. Again, it's not going to be concrete numbers that you can just take away and get a loan. If it says you can borrow 500,000, doesn't mean it's 100% accurate. You still need to come speak to a broker, but it might just give you a good sort of step in the right direction of what's going to be possible for you in terms of buying a property. So if you want to check them out, link will be down below. You can go to our website and have a play around with these calculators. So again, my name's Nick, Kingfisher Finance. We offer strategic finance for first-time buyers and investors. If you'd like to book a chat with me, you can do so with the QR code, or there'll be a link down below. Book a free session. We'll just go through your situation, what you're looking at doing, and potentially we can help you get started on your journey. So look forward to chatting.